This is a calculator, a basic Casio, the kind you can buy at any office supply store for $8. It performs addition, subtraction, multiplication, division, simple arithmetic that anyone can verify. I'm going to use this calculator to show you something that the most sophisticated financial analysts in the world are missing. Not because the math is complex, the math is elementary. They're missing it because the math contradicts everything they believe about how markets work. Here's the calculation. Total Bitcoin supply, 21 million coins. That's the maximum that will ever exist. Subtract the approximately 4 million coins that are permanently lost, wallets with forgotten passwords, hard drives in landfills, coins sent to burn addresses. Remaining accessible supply, 17 million coins. Now subtract the coins held by entities that have publicly committed to never selling. MicroStrategy's 471,000. The U.S. government seized holdings of approximately 200,000. The various sovereign and quasi-sovereign holdings that have emerged over the past 2 years, conservatively another 300,000. Long-term holders who haven't moved coins in 5 years or more, statistically unlikely to sell at any price, approximately 6.2 million, according to on-chain analysis. Remaining liquid supply, approximately 9.8 million Bitcoin. Current price, approximately $98,000. Total market cap of liquid supply, $960 billion. Now here's where the calculation gets interesting. Institutional money that has publicly announced intention to allocate to Bitcoin in 2026 through ETF filings, pension fund amendments, sovereign wealth fund disclosures, and corporate treasury programs. $147 billion. That's not speculation about what might happen. That's documented, filed with regulators, committed capital that will execute over the coming months. $147 billion chasing 9.8 million liquid coins. The math. $147 billion divided by 9.8 million equals $15,000 of new demand per available coin. Add $15,000 to the current price of $98,000. You get $113,000 just from the already committed institutional flows, assuming no additional demand, no retail participation, no further institutional announcements. But that assumption is wrong. Institutional announcements beget more institutional announcements. Each allocation provides cover for the next. The $147 billion committed today becomes $300 billion committed by June. Run the same calculation with $300 billion chasing 9.8 million coins. The incremental demand, $30,600 per coin. Add to current price, $128,600. But that calculation is also wrong, because the 9.8 million liquid supply doesn't stay liquid. Each institutional purchase removes coins from circulation. MicroStrategy doesn't sell. BlackRock's ETF doesn't sell. The coins that enter institutional custody don't re-enter the market. The denominator shrinks while the numerator grows. The price impact isn't linear, it's exponential. Run the calculation correctly, with shrinking supply and compounding demand over 8 months, and the number that emerges isn't $128,000. It's not $200,000. It's not $350,000. The number is $500,000. And the calculator doesn't care whether you believe it. Here's what they're not telling you. The consensus forecast for Bitcoin in 2026 ranges from $85,000 to $150,000, depending on whose research you trust. The analysts producing these forecasts use sophisticated models, incorporating on-chain metrics, network effects, stock-to-flow ratios, and macroeconomic variables. Every one of these models contains the same error. They assume that supply and demand operate independently, that a certain amount of demand will be met by a certain amount of supply at a price that equilibrates the two. This assumption works for most assets. If gold demand increases, miners increase production. If oil demand increases, OPEC adjusts output. If stock demand increases, companies issue shares. Supply responds to price signals, moderating price increases. Bitcoin cannot respond. The supply schedule is fixed by code that cannot be changed without consensus that will never exist. When demand increases, supply cannot increase in response. The only variable that adjusts is price. The models forecasting $150,000 assume demand grows at historical rates. They don't account for the structural shift occurring right now, the transition from speculative asset to institutional allocation, from retail phenomenon to pension fund holding. The demand hitting Bitcoin in 2026 is qualitatively different from any demand it has previously absorbed. This isn't retail traders chasing price momentum. This is pension funds implementing strategic allocation, sovereign wealth funds diversifying reserves, corporate treasuries hedging currency exposure, central banks exploring digital alternatives to dollar reserves. The capital pools considering Bitcoin allocation in 2026 total over $40 trillion. The committed $147 billion represents less than 0.4% of this addressable market. If allocation rates reach 1%, still trivially small by institutional standards, demand reaches $400 billion. $400 billion chasing a shrinking pool of liquid coins. The calculator doesn't forecast. The calculator just divides. And when you divide $400 billion by 8 million coins, accounting for supply removed by ongoing accumulation, the quotient exceeds $500,000. The analysts aren't wrong because their models are flawed. They're wrong because their models can't incorporate a demand shock of this magnitude, because nothing like it has ever happened before. This is where the lie becomes unsustainable. The financial media covers Bitcoin as if it were a stock, discussing earnings equivalents, adoption metrics, and competitive positioning. This framing fundamentally misunderstands what Bitcoin is. Bitcoin is not a company. It doesn't have earnings. It doesn't have competitors in the traditional sense. It's a monetary network with fixed supply, and its value derives from one thing only: how much humanity collectively decides to store in it. The paper versus physical distinction that has defined precious metals for centuries now applies to Bitcoin with even greater force. Paper Bitcoin, exchange balances, ETF shares, custodied holdings, represents claims on Bitcoin held by institutions. Physical Bitcoin, self-custodied coins controlled by private keys, represents actual possession. The demand entering the market in 2026 is almost entirely for paper Bitcoin. Pension funds don't self-custody. Sovereign wealth funds don't manage private keys. The institutional capital flowing in creates claims on coins held by custodians like Coinbase, Fidelity, and BitGo. This creates a structural dynamic the models don't capture. The coins backing ETF shares and institutional custody arrangements are nominally available to the market, but practically unavailable. The custodians can't sell coins backing client positions. The coins exist in a kind of limbo, not lost, not liquid, but removed from circulating supply indefinitely. Each institutional purchase removes coins from the liquid pool while adding a claim to the paper pool. The ratio of claims to coins can expand without limit. We've seen this dynamic in gold markets, where paper claims exceed physical supply by ratios of 100 to 1 or higher. Bitcoin's transparency makes this ratio visible in real time. On-chain analysis shows exactly how many coins sit in custodial addresses, how many are moving, how many have been stationary for years. The data shows liquidity shrinking faster than models anticipated. Exchange balances have fallen from 2.7 million Bitcoin in January 2022 to 1.8 million in January 2026. 900,000 coins, $88 billion at current prices, have moved off exchanges into long-term storage. The trend is accelerating, not slowing. The models assume historical liquidity. The data shows liquidity contracting. The gap between assumption and reality is where the $500,000 price emerges. When institutions do what they're doing now, they're not making speculative bets. They're implementing allocation decisions that take years to fully execute. At 2:15 p.m. Eastern on January 24, 2026, the California State Teachers Retirement System, CalSTRS, the second largest pension fund in America, filed an amendment to their investment policy statement. The amendment added digital assets to the list of permissible alternative investments, with allocation limits of 1 to 3% depending on fund strategy. CalSTRS manages $352 billion. A 1% allocation represents $3.52 billion. A 3% allocation represents $10.56 billion. From a single pension fund, one filing, one amendment. The filing doesn't commit CalSTRS to buying Bitcoin tomorrow. It creates permission to buy Bitcoin over the coming months and years. The actual purchases will occur gradually, through ETF allocations, separately managed accounts, and direct custody arrangements that take time to establish. But the filing signals intent, and intent, in institutional markets, creates momentum. Within 72 hours of CalSTRS filing, similar amendments appeared from the Florida State Board of Administration, $255 billion, the New York State Common Retirement Fund, $268 billion, and the Teacher Retirement System of Texas, $201 billion. Combined assets, $1.076 trillion. Combined potential Bitcoin allocation at 1%, $10.76 billion. At 3%, $32.3 billion. The filings keep coming. Each one creates cover for the next. The CIO, who would have been fired for proposing Bitcoin allocation in 2024, now faces questions about why the fund isn't allocated when peers are filing amendments. The institutional FOMO that skeptics dismissed as impossible is manifesting in regulatory filings. The capital that seemed too conservative to touch cryptocurrency is establishing legal frameworks to buy it. The demand wave that the $500,000 calculation anticipates is forming in investment policy committees across the country. Less than 8 months remain until the end of Q3 2026, the window when most institutional allocation decisions adopted in Q1 will fully execute. The capital committed in January files reaches the market by September. The price impact follows the capital. The countdown isn't to a single event, it's to a cascade of purchases, each one raising prices, each price increase validating the allocation decision, each validation encouraging additional allocation. The feedback loop that propelled Bitcoin from $1 to $69,000 is re-engaging at institutional scale. The difference is the capital pools involved. Retail enthusiasm pushed Bitcoin to $69,000. Institutional allocation will push it to $500,000. While Western institutions file amendments, Eastern institutions are already positioned. At 9 a.m. Singapore time on January 28, 2026, 8 p.m. Eastern the previous day, Temasek Holdings, Singapore's sovereign wealth fund, published its annual portfolio review. The review disclosed digital asset holdings of $4.2 billion, a figure that had not appeared in previous disclosures. The holdings represented approximately 1.1% of Temasek's $380 billion portfolio. Temasek had previously written off a $275 million investment in FTX as a complete loss in 2022. The financial media covered the FTX exposure extensively, framing it as evidence that sophisticated investors recognized cryptocurrency's dangers. The media didn't cover what happened next. Temasek quietly accumulated $4.2 billion in Bitcoin and Ethereum through 2023, 2024, and 2025, rebuilding crypto exposure at 15 times the magnitude of the FTX write-off. The loss that supposedly proved cryptocurrency was too risky actually convinced Temasek to increase allocation dramatically. The $4.2 billion position wasn't announced through press releases or interviews. It appeared in an annual report that most Western media didn't read. The accumulation occurred over years, invisible until disclosure requirements made it public. Temasek is not unique. Singapore's GIC, $770 billion, has acknowledged exploratory positions in digital assets without specifying magnitude. The Abu Dhabi Investment Authority, $990 billion, holds positions through portfolio companies that aren't required to report cryptocurrency exposure separately. The Kuwait Investment Authority, $900 billion, has similarly acknowledged digital asset exploration. The sovereign wealth funds representing trillions in capital are already in Bitcoin. Their positions aren't fully visible because disclosure requirements vary by jurisdiction. The Western analysts forecasting $150,000 are working with incomplete information about demand that's already arrived. The $500,000 calculation incorporates an estimate of this invisible demand, the positions that exist but aren't disclosed, the allocations that have executed but haven't been reported. The estimate is conservative. The actual sovereign exposure may be substantially higher. The BRICS dimension amplifies the demand picture further. The January summit working papers on digital reserve diversification proposed that member nations consider Bitcoin alongside gold as a component of national reserves. The proposal isn't binding policy, but it reflects discussions occurring at the highest levels of nations, representing 46% of global population. If BRICS nations implement even modest reserve allocation to Bitcoin, say 0.5% of combined foreign exchange reserves of $4.2 trillion, that's $21 billion in additional demand from central banks alone. Central bank demand operates differently than institutional demand. It's not price sensitive, doesn't trade momentum, and doesn't sell during drawdown. Central bank accumulation removes coins from circulation permanently, even more permanently than institutional allocation. The coins entering sovereign reserves in Moscow, Beijing, Riyadh, and New Delhi aren't returning to Western exchanges. They're joining strategic holdings that nations accumulate for decades. The supply math that produces $500,000 assumes institutional demand. Adding sovereign demand to the calculation produces numbers that seem absurd against current prices, but emerge naturally from the arithmetic of fixed supply meeting exponential demand growth. This is what a system looks like when it undergoes phase transition. The objection to $500,000 is always the same. Bitcoin can't possibly quintuple in 8 months. The objection treats Bitcoin's historical price range as a constraint on future prices. But Bitcoin's history includes multiple 5x moves in comparable timeframes. The 2017 run from $1,000 to $20,000 occurred over 12 months. The 2020-2021 run from $10,000 to $69,000 occurred over 14 months. A move from $98,000 to $500,000 over 8 months represents a 410% gain, larger than 2017, but smaller than 2020-2021 in percentage terms. The skeptics weren't wrong to doubt $1,000 Bitcoin or $10,000 Bitcoin or $69,000 Bitcoin. They were wrong to assume that historical prices constrained future prices. Bitcoin's price is whatever equation balances demand against supply. And when demand grows exponentially while supply remains fixed, prices move exponentially too. The trap has no exit for shorts who don't understand this dynamic. Bitcoin futures short interest currently exceeds $14 billion, positions that profit if prices fall. The shorts assume mean reversion, that the current rally is temporary, that prices will return to some historical average, that the institutional demand is hype rather than structural. Each price increase above current levels forces shorts to either post additional margin or close positions. The margin calls create buying pressure. Short covering is indistinguishable from new long positions in its impact on price. The buying pressure raises prices further, triggering more margin calls. The short squeeze mechanics are visible in market microstructure data. Funding rates on perpetual futures contracts have remained elevated for 6 consecutive weeks. The elevated funding reflects perpetual short sellers paying premiums to maintain positions, a cost that accumulates daily and eventually forces capitulation. When the capitulation comes, when the $14 billion in shorts begins covering, the buying pressure compounds the institutional demand already entering the market. Short covering on top of pension fund allocation on top of sovereign accumulation. The supply math that produces $500,000 becomes the supply math that produces something higher. The question for anyone holding cash or positioned short isn't whether $500,000 is possible. The calculator answers that question. The question is whether you want to be positioned correctly when the arithmetic manifests in market prices, or positioned incorrectly, watching the move from the wrong side. Those who positioned for $20,000 Bitcoin in 2017 seemed reckless until they weren't. Those who positioned for $69,000 in 2021 seemed delusional until they weren't. Those positioning for $500,000 in 2026 seem absurd now, but the calculator doesn't care about consensus opinion. Reality asserts itself through price discovery that incorporates all buying and selling pressure, whether the market believes the resulting price or not. The market believed $1,000 was Bitcoin's ceiling until it wasn't. The market believed $10,000 was unsustainable until it wasn't. The market will believe $500,000 is impossible until one day, probably within 8 months, it isn't. The calculator shows why everyone is wrong. Not because the analysis is sophisticated, not because the model incorporates variables others miss, because the analysis is simple enough that an $8 calculator can perform it. Supply, fixed, shrinking in liquid terms, declining every day as coins enter long-term storage. Demand, exponential, compounding, documented in regulatory filings that represent committed capital rather than speculative interest. Price, the variable that adjusts to equilibrate supply and demand that cannot equilibrate any other way. 21 million total, 17 million accessible, 9.8 million liquid. 8 months of institutional allocation totaling $300 to $400 billion. The calculator divides. The quotient exceeds $500,000. The consensus sees $150,000 because the consensus uses models built for assets that can expand supply in response to price. The consensus is wrong because Bitcoin cannot expand supply. The consensus will discover it's wrong when prices reach levels the models said were impossible. 8 months. The institutional capital is committed. The sovereign positions are building. The short interest is accumulated. The calculator doesn't forecast. The calculator doesn't speculate. The calculator performs division. $500,000 is the quotient. 8 months is the time frame. The calculator is sitting on my desk, available for anyone to verify. Everyone is wrong because everyone is using the wrong model. The right model is arithmetic. The right model fits in your pocket and costs $8. The arithmetic says $500,000. The arithmetic is patient. The arithmetic will wait for the market to catch up. It usually does. It usually takes less time than people expect. 8 months. The countdown has already begun.